All right, Miriam.
Hello, everybody. Thank you for joining us today. You're here today because you've all heard about the tax reform, which is the most comprehensive tax reform passed in the last 30 years and comes with so many different tax aspects. Today, specifically, we're going to focus on the issues that are most relevant to Israeli high-tech companies, those that either have got a U.S. parent company and an Israeli subsidiary, or vice versa, where they have an Israeli parent company and headquarters in Israel with a U.S. subsidiary. Tanina, you want to take us to the next slide, please? The specific topics that we're going to cover today, as you all may know, the tax reform passed for 2018, but there are already some provisions that are going to impact the 2017 tax filings. That's the first issue that we're going to cover. Then the next topic is that there's a shift in the U.S. from taxing income on a worldwide basis to only taxing income on what will actually be earned in the U.S. So that will be the shift from the worldwide to the territorial tax system. But in order to achieve that, as part of the tax reform, first there's going to be a one-time transfer tax known as deemed repatriation. Following that, we're going to touch upon the new tax, which has been passed as part of the reform, known as the GILTI. That's an additional tax. But then we're going to introduce the topic called FDII, which actually provides for a reduced rate of tax for specific types of income. So we'll elaborate on that. Then we'll go on to various provisions that are very relevant to tech companies. And we'll also talk about the new stock option benefits, which is a topic also very relevant to tech companies in attracting and incentivizing their employees. We'll discuss what are the new changes that have come out that may be very relevant for your employees. But I think before we take a deep dive into those issues, Tanina is going to lead us through our first polling question.
Great. Going to launch the first poll now. Okay. Okay, and we'll leave this poll open for about another 30 seconds. And just remember that if you are requesting US CPE credit, participation in the polls is required. Okay, another 10 seconds. All right, we're going to close the poll and share the results. So it looks like C, 52%. No, I'm very interested in learning today. All right, we'll move on.
Okay, thank you. So that's what we were actually anticipating to see, because that means firstly we're going to have a very attentive audience. And what our goal is today is to really simplify these complex issues in the tax reform and translate that into something that's actually very meaningful and which you'll directly be able to relate to. So what I'm going to start with is the most common structure that we see in relation to Israeli tech companies doing business in the US. Generally, what we have is the Israeli parent company operating as the headquarters, and then we have the U.S. subsidiary, which often functions as the sales and marketing arm of the Israeli parent company, which has already invested in the technology, developed the product, and now wants to take the product to the U.S. market. Now, these subsidiaries are functioning as what is called an LRD, limited risk or low risk distributors. And so the risk is on the parent company, and the U.S. company generally, for transfer pricing purposes, will retain a minimal profit in terms of receiving a commission for the services that they are providing. Now, until the tax reform passed, the goal of these entities and the profits that they were earning in the U.S. was to shift as much as possible from the U.S. high tax regime of 35% over to Israel, which had a corporate tax rate through 2017 of 24%. Now, what the tax reform has done, it has lowered the tax rate in the U.S. to 21% and essentially leveled the playing field so that there isn't only now an entire focus of shifting the profits over to Israel. We can now consider additional possibilities. We'll go into that a little bit later in the webcast, in which we talk about what are different planning opportunities that we can do. What I want to focus on right now actually is how does this already impact, how does the lower tax rate of 21% already impact the 2017 tax filings? Janina, can you take us to the next slide, please? So here's what we're going to do in terms of already taking advantage of the 14% tax rate difference that we're looking at in 2017, which is still taxed at the 35% rate, versus 2018 when it's going to be dropping down to 21%. So this will actually already impact the tax return or the extension that is going to be filed within 2.5 months on April 15th, 2018. So the first thing that we're going to want to make sure that we're taking advantage of is that we're pushing as many expenses as possible into 2017, because that's going to give us the advantage of the 35% lower, greater tax rate, but a greater deduction in the year where the tax rates are higher. So how are we going to do that? You may already have accrued expenses on your books for 2017, but what you may not be aware of is that if those expenses are not paid timely within the certain timeframes required by the IRS regulations, then those expenses will actually be delayed for a recognized tax deduction until 2018. So while that deduction would have been available in 2017 and provided you with a deduction that had a 35% tax rate, if that isn't paid timely, it's going to be pushed into 2018, where that deduction is only going to give you a 21% rate. So what specific deductions are we talking about? This would be the accrued commissions or bonuses which you have on your books, and if that's specifically in relation to employees, you're going to want to make sure that those are paid by March 15th. Now, other accrued expenses which need to be paid in order to take advantage of them in the 2017 tax filing are expenses paid not to employees, must be paid by September 15th. So make sure that those get paid by that due date or by the filing of your tax return, whichever one comes earlier. Another thing that you want to make sure to take advantage of is that if you have made any capital purchases, such as hardware or software, rather than depreciating that over the life of the asset, you're going to want to make sure to take a 100% deduction so that you get the full advantage of that under Section 179 and a complete deduction at the 35% tax rate. That's in terms of pushing down expenses. On the flip side, if there's revenue that can be deferred to 2018, you're certainly going to want to do that in terms of taking advantage of the lower tax rate in 2018. So another example of, other than the standard revenue, of course, if there's deferred revenue that's been received, according to IRS regulations, you either need to recognize that immediately in the year of receipt, or you do have the option to delay that to the next tax year. So any deferred revenue received in 2017, you're certainly going to want to make that election to defer that to 2018. The one last point that I would say in relation to this is that you will already see an immediate impact of the lower tax rates right now is if you're preparing your 2018 tax provisions or paying your corporate estimates, then that's something that you will already see a drop in the tax rate and the amount of taxes that you're paying compared to the year before. Next slide, please. Okay, so we talked about the tax impact on LRDs, and when the U.S. company is the one that's functioning as the distributing arm of the Israeli parent company. What happens with the alternative structure, which is when we have the U.S. parent company, which often functions as the holding company, and the Israeli subsidiary is the one which is the active startup where the management, finance, and the R&D team is located. Generally, these types of structures were used in terms of raising financing from the investors and then channeling those funds over to the Israeli subsidiary. Now, what's interesting about this type of structure is that while it works for our clients in the startup world, it's similar to what multinational entities such as Google or Microsoft were using in terms of generating income outside the US. So for example, of course, Microsoft headquarters are located in the US. But then they also have offshore entities located, for example, in Ireland. And those entities are the ones that are selling to the rest of the world and have been generating a significant amount of profits over the years. Now, a tremendous target of the tax reform was to be able to bring all those profits offshore back to the US. And so what's going to happen right now is that as part of the reform, the target was to have a one-time tax repatriation to bring those funds that are all sitting outside the US and back to the US for funding. So I'm going to hand this over now to Chaya so you can explain to us how these tax structures initially, where we have the US parent company and offshore subsidiaries, how are they taxed until now, and what is that going to look like going forward?
Thank you, Miriam, and thank you everyone for joining us. So in the past, in the US, we had a worldwide tax system, where if you had a U.S. company with an Israeli subsidiary, if the Israeli subsidiary had income of $1 million, that income was taxed at the 24% Israeli corporate rate, and upon distribution back up to the U.S. company, the income was subject to U.S. tax at a 35% rate with a foreign tax credit offset for the Israeli tax paid. So the overall worldwide tax paid on this $1 million of income was $350,000, which is the 35% US rate. Going forward, we're moving to a territorial tax system. So same fact pattern, but now the $1 million of income that is going to be taxed in Israel, the corporate rate is going down to 23%, so it will be taxed at a 23% rate. Upon distribution to the U.S., it will not be subject to tax again due to a dividend received deduction. There's a little asterisk there to indicate that this assumes that there's no subpart F or GILTI income, which we'll talk about what GILTI is. But the general rule is income of a subsidiary of a U.S. corporation will be subject to tax in the subsidiary's local country and not subject to tax again in the U.S. when repatriated. Tanina, next slide, thanks. So there are a couple of rules around this, and number one, this dividend received deduction to get us down to the no tax in the U.S. is only available to U.S. C corporations that own 10% or more of the foreign subsidiary. There's a holding period requirement of a year, and again, this is effective for tax years beginning after December 31st, 2017. So the question is, how do we move from a tax system where we were taxed on our worldwide income to this territorial tax system? And the answer is with this one-time mandatory deemed repatriation tax, or the transition tax as it's being referred to. So this transition tax, the way it works is any U.S. person that owns, that has a deferred foreign corporation, will be deemed to repatriate the deferred earnings in the foreign entity. So any previously untaxed earnings in a foreign subsidiary of a U.S. corporation will now be deemed repatriated to the U.S. and subject to tax at either a 15.5% rate or an 8% rate, depending on the balance sheet of the foreign entity. So to the extent that these earnings that haven't previously been subject to U.S. tax are held in cash or other liquid assets, the tax rate for that income will be 15.5%. And to the extent these earnings are not held in cash, they're held in other assets, the tax rate will be 8%. Now there's an ability, so this transition tax is deemed to have occurred during 2017. So the tax would actually be due with the extension for the 2017 return, which is in 2.5 months, as Miriam pointed out earlier. But there is an election to pay this tax over 8 years. With the earlier years, you would only pay 8% of the tax that's due, and then the last couple of years, you would pay the remainder. Next slide, please. Okay, so just to clarify who this applies to. So it's any U.S. person that owns a CFC. So this applies to an individual or an entity that owns a CFC, and a CFC is a controlled foreign corporation, which is a foreign corporation, foreign to the U.S. So it's a foreign corporation that has more than 50% U.S. shareholders. Doesn't matter if those shareholders are individuals or entities or C corps. It also applies on the left, we have a U.S. person, so that refers to a U.S. corporation that owns 10% or more of any foreign entity. And this does not apply to PFICs, as our passive foreign investment companies. So this mandatory repatriation rule does not apply to those entities. So again, it's your CFCs and any C corp that owns 10% or more of a foreign subsidiary. So the way that they wrote this, and there was a lot of talk in the US about simplifying the tax code. Well, I can assure you that on the international provisions, there's nothing near simplification. Everything is confusing. It seems that the way things are done is, introducing extra steps that weren't necessary. So case in point, the way that this 8% tax rate is applied to the deemed repatriation income, say for instance, you had a deemed repatriation income of $100,000, you would have to figure to offset this repatriation tax. However, the foreign tax credit does get a haircut, so you can only take the percentage of the credit that you've picked up the income. So you'll see the 22% represents the amount of taxable income, actual taxable income compared to the deemed repatriated amount. So this available foreign tax credit of $24,000 takes a significant haircut, and only 22% of it is available. And so the actual tax on repatriation, instead of being $8,000, the U.S. tax on repatriation will be the $2,500. Now, some good news and some bad news, I guess, at the same time. So what's interesting here with the mandatory repatriation is that Congress has allowed for netting. So this tax is applied at the U.S. shareholder level, not at the foreign entity level. Most of the historical U.S. international tax provisions apply at the entity level, and so all tracking of earnings and profits, you see EMP that represents earnings and profits, or your tax retained earnings. So historically, and all the historical provisions, all of those computations are done at the entity level. But for this mandatory repatriation, it's done at the U.S. shareholder level. And why that's good news is because if you have losses in one foreign subsidiary and income accumulated earnings in another, you can actually at the shareholder level offset the two to reduce your repatriation tax. This is a very simple, well, it's actually not so simple. This is, in this picture, the US corporate shareholder owns 100% of entity A and only 33% of entity B. So they would have to recognize the $100 of E&P from corporation A, and then they would be allowed to offset that income with the $33 of losses that are allocated to them because they only own 33%. So it would reduce their mandatory repatriation amount by the $33 to bring it to $67. Now, this is a fairly simplified example, but if you're dealing with multiple shareholders and multiple foreign subsidiaries, it could get more complicated. So that's where it gets a little tricky, is that the computation and the tracking of all the information gets a bit technical. Okay, so I had mentioned earlier that you can elect to pay the tax over 8 years, and so this is just the schedule of how much you would pay in each year if you do make that election. There is no, if you elect to pay over 8 years, there is no interest or penalties on paying the tax over the 8 years.
Okay, and that brings us to our second polling question. Going to launch that now, and we'll leave this open for 45 seconds. And hi, Anne Miriam, we do have some questions coming in. I don't know if you want to look at them now or at the end of the webinar.
Okay, well, I actually want to add something in relation to the point which Chaya mentioned earlier. So thank you, Chaya, for walking us through that tax calculation and how we can obtain a foreign tax credit and reduce the tax due in the U.S. on this repatriation tax. What I want to point out is that if there's a situation where we have the U.S. parent company, which we said has been functioning in many cases as the holding company, has been funding the Israeli subsidiary, let's say on a cost-plus basis. So that typical structure where the Israeli company has been operating on cost-plus and generating those profits, they would be a company that falls under this category, which is required to deal with a repatriation tax right now. And so they would have the foreign tax credits available. But remember that on the parent company level, they may have significant losses from prior years. And so those losses can be used, obviously, to offset the repatriation tax. As a matter of fact, there are some companies that may even choose to make an election not to use those losses, because effectively this repatriation dividend is being taxed at the lower tax rates of either 8% or 15.5%, as Chaya mentioned to us. And so some companies may want to hold on to their net operating losses and not use that right now to offset income that potentially is being taxed at a very low tax rate. So I just wanted to add that point. Thank you, Chaya, for that clear explanation.
Sure, and we have, okay, I guess right after the polling questions, we can take the other questions that came in.
I was just going to share the results very quickly. It looks like 46% D, no impact, and then 32% D does not apply, while 3% said significantly and 19% said moderately. So hide that, and then you can continue with the questions if you'd like.
Okay, so there was a question that came in if the deemed repatriation tax will apply to a CFC formed in 2017, and the answer to that is yes, it would. Declaring a dividend, there was another question, would a declared or a dividend accrued as of 12/31/17 affect the amount of the repatriation? And the answer is no. The way the ordering rules work is you would have to look at the full year, and you look at the full year E&P, first apply the mandatory deemed repatriation, and then after that, if you declared a dividend, it would be treated as a dividend, a distribution paid out of previously taxed income. So what happens to the amount that you've picked up as a deemed repatriation, it gets put into this pool that we call previously taxed income. And then to the extent that cash or property is distributed out of the foreign entity to the U.S. shareholder, to the extent that there's a PTI, or this previously taxed income amount, the income would not be subject to tax, or the cash distribution would not be subject to tax again in the US. So that's what would happen to your dividend that you declared as of 12/31/17. It would just be considered paid out of PTI. And I think that was the only question. So yeah, we can move on. So moving into beyond 2017, going forward, what the tax landscape will look like. There's been this perceived attempt at taking IP and moving outside of the US. So people have been offshoring their IP in an effort to reduce their taxable income base in the US. And one of the big policy motivators behind the law was to try to stop this kind of activity. And in an effort to do that, the law introduced two new concepts. One is a penalty for the companies that have moved their IP out of the US or will move their IP out of the US. And then another is a benefit similar to an IP box to get US companies to keep their IP in the US, and perhaps even foreign entities to bring their IP if they're looking for a location to house their IP, to house it in the US at this more beneficial tax rate. So looking at the first type of, the penalty is this new type of income called Global Intangible Low Taxed Income, or the acronym GILTI. And if you're wondering if GILTI is a good thing, no, it is not a good thing to have. And I think that the connotation of the acronym is makes that very clear. So what is GILTI? GILTI is a new type of income that, if earned by a controlled foreign corporation or a CFC, is deemed repatriated to the shareholder, to the US shareholder, in the year it's earned. So it's similar in that sense to Subpart F income. And just to give a little bit of background to those who may not be familiar with that terminology, the general rule in the US is that the income that's earned by a foreign subsidiary will only be taxed in that local country. That's what we had discussed earlier when we spoke about the territorial tax system that we are now, because we're in 2018, the system that we're now in, where US parent company, foreign subsidiary, the income that's earned in the foreign subsidiary should only be taxed in that foreign subsidiary. Now, the exception to that rule is anytime you have tainted, we'll call it tainted income. One type of tainted income that we've had historically and we will continue to have, the Subpart F, and we won't go into that. But another type of tainted income is now this GILTI income. Now, what is GILTI income? So, as I mentioned, this is an attempt to halt the activity of offshoring IP. And so what Congress have said is income that is associated with fixed assets, we will not tax that income as GILTI. But any income that is generated by intangible assets, that will be treated as GILTI income. Now, it's important to note that we don't have, the rule does not tell us to specifically trace our income to the different asset pools. It actually sets a specific formula of how we come up with this GILTI amount. So on the left side of the screen, we have our depreciable assets, trade or business assets, you know, your machinery or equipment. The assets that you use, we'll refer to those as your qualified business asset investments. So your fixed assets. And what the law says is we anticipate a 10% rate of return on those assets. So up to the extent of 10% rate of return, that income is going to be associated with your tangible assets, your fixed assets. Everything else, in addition to that 10% rate of return, anything on top of that is going to be your global intangible low taxed income. That is going to be your GILTI income. So that would be the income that is generated by your marketing intangibles, your computer software, your customer list, your goodwill, copyrights, patents, and similar property. So the concept here, and those of you that have done transfer pricing, it's easier to set a fixed rate of return on your tangible assets, and everything else, because it is intangible, it's a bit more elusive. So it's 10% rate of return on your fixed assets, and everything on top of that is GILTI. So
Chaya, just to clarify something, in that situation, when we've got the typical high-tech company, so the amount of capital that they're holding on to is pretty much going to be the computers, fixed asset, things that these companies have just in terms of employees in their offices. So we're not looking at a very high capital based company. And so pretty much we would say that 10% on that is going to be a fairly low rate of return. So we see GILTI as being something pretty relevant for companies that are operating in the tech space.
Yes, it is. And I will say it's not as bad as it sounds, and we'll get to that in a minute. It's not as bad as it sounds for Israeli companies, and I'll talk about that in a minute, why that is. But yes, it will definitely impact your tech companies. That's pretty much who they were targeting, the companies that have high IP. But believe it or not, it affects and impacts really many CFCs, many foreign subsidiaries in many industries, because a 10% rate of return on fixed assets is really not that high. So it's definitely far-reaching, but for the tech sector, definitely will impact them. So the specific formula of how we arrive at our GILTI income is your CFC income less this 10% of your qualified business asset investment. Your CFC tested income is your CFC income less any income that's effectively connected with a U.S. trade or business, any income that's already included as Subpart F, or if it was excluded under a high tax kickout, and then a dividend received from a related person or foreign oil or gas. So we actually have, Tanina, if you can jump to the next slide. And this is the discussion of, just to highlight what your qualified business asset investment are. But one more slide, Tanina. Okay, so just to put some numbers to it, sometimes it's easier to understand when we're actually dealing with numbers. Here you have a U.S. parent company with a CFC that has $1 million of income. This is an Irish CFC, so it's taxed at 12.5%. So our EMP, and the EMP is your U.S. tax retained earnings concept. This company has Subpart F income of $200,000. So our remaining CFC tested income, the amount of income that could potentially be GILTI, is your $675,000. Now this company has $2 million in office equipment. So it's allowed a 10% rate of return. So it's got $200,000 of fixed return income. And then anything on top of that is going to be your GILTI. So you have $475,000 of GILTI income. So again, just to highlight, we're not actually tracing income to assets. It's just this 10% rate of return that's allowed. Now, how is this income taxed? Tanina, if you can go to the next slide. If you are a C Corp shareholder in the US, you actually get a reduced tax rate on GILTI. So you're only taxed at 10.5% in the US on your GILTI income if you're a C Corp shareholder. And you are also allowed a foreign tax credit, but the foreign tax credit that you're allowed is only 80%. So if the local country of the CFC, if the income in that country is taxed at less than 13%, you would have a residual US tax, because 80% of your foreign tax credit is going to be less than the US tax of 10.5%. So you have this residual tax. But if you look on the right side where we have the Israeli numbers plugged in, because your Israeli corporate tax is 23% and you're allowed an 80% foreign tax credit on that, you would not have a residual income tax on your GILTI income. There would not be a residual tax on your GILTI income in the US. Now, I caution that the tax rate that we're looking at, it's your actual taxes paid. It's not your statutory rate. So in this example, we're just assuming that your effective tax rate in Israel is the 23% statutory rate. But if for some reason you're paying less than 13% tax in Israel on this bucket of income, you will have a residual US tax. So it will, this is something that you do need to be aware of because it will impact your company. The question of whether or not you'll have a residual US tax will depend on what rate of tax you're paying in the US on your, in Israel, I'm sorry, on this income. And so if there's, you know, I know that you have a reduced rate of tax on IP similar to what we'll talk about FDII, so it's kind of like an IP box concept in Israel as well. You may have NOL carry forwards, things of that nature. So just something to keep in mind.
Thank you. That's a good point, Chaya. What I want to clarify with that is that in the structure where we're looking at where the U.S. has been a parent company and using the Israeli subsidiary just to be the R&D entity to develop the technology, then generally they're operating on a cost plus. The profit that would be in the Israeli company would be fairly low, and the tax rate in that case would generally be the higher 23% rate. So that falls in line with what the U.S. is trying to do, which is to encourage the main IP to be held in the U.S. company and anything offshore to have really a limited limited profits outside the U.S. And in that case, the GILTI wouldn't be so disastrous. It would actually work to the client's benefit, to the taxpayer's benefit. You have the 23% tax rate that's sufficient in order to offset your GILTI tax in the U.S. But in a flip situation, which is what we're actually going to get into right now, what happens when the IP is in the U.S. versus when the IP is in Israel? So in the case where the IP is in Israel and the tax rates may be reduced to much lower, such as 12%, then we would have a GILTI situation with not necessarily the foreign tax credits to offset it. So let's look at what the U.S. is doing right now in terms of encouraging foreign companies to, yes, keep the IP in the U.S. and offer advantages similar to what Israel does and lower tax rates for these technology companies. Chaya, can you walk us through the FDII, who that may be relevant to, and how we can take advantage of
Sure.
it?
If I can just, there was one question that came in that is very important that I would like to address, and that is, the question came in, will GILTI income be taxable to U.S. individuals who own foreign companies? So the answer is yes. And for individuals, it's a lot worse because there is no reduced rate of tax. So that 10.5% rate that we mentioned, that's only for U.S. C Corp shareholders. So if an individual has GILTI income, it will be taxed at your highest individual rate. And there's not going to be a foreign tax credit offset either. So it's definitely a very bad situation to be in. The one thing to highlight, though, is GILTI income can only be from a controlled foreign corporation. So if you have a U.S. individual that owns 10% of an Israeli company, if he's the only U.S. individual that has any interest in the Israeli company, it's not a controlled foreign corporation. So the first test to look at is the Israeli company or the foreign entity, is it a CFC? Is it a controlled foreign corporation? And if it is, you may have a GILTI issue if you're an individual. There is another question. I apologize. It's a little bit difficult for me to see the question.
Would you like me to read it, Chaya?
Yes, if you can, please.
Or the last one that came in at
Yes.
9:39?
Yes.
Or if the foreign sub has an NOL, then in the first year of profits, will the U.S. owner be subject to the GILTI tax on the current year's earnings, or are the NOLs in the foreign sub recognized?
Okay, and the way that the law was written, there's a lot of room for interpretation. It's very light on details, and so the way it's written right now, it looks like there may be a GILTI tax in that scenario. I will caution, though, that we anticipate many regulations to come out, and I would anticipate that that particular issue will be addressed in some of the regulations that will be coming out. So I don't have a good answer for you right now. The answer is really we need to wait and see what regulations come out of the Treasury Department to see how a scenario like that would be addressed, because right now it does look like it would be subject to the GILTI tax. Okay, so now that we spoke about the penalty side, we can talk about the benefits and what the U.S. is doing in an attempt to try to entice IP owners to leave it or to move it to the U.S. And so with that, we move to the FDII, which is your foreign derived intangible income. And what this benefit is it's a reduced rate of tax. Again, this is only available for C Corp shareholders. So if you're a C Corp shareholder, if you're a C Corp, it's actually a C Corp in the U.S. that owns intangible assets. To the extent you have foreign derived income on those intangible assets, you will get a reduced rate of tax of 13.125%. So it's a beneficial, it's a new basket of income that benefits from a reduced rate of tax. Now, what is this foreign derived intangible income? This is pretty much the reverse of GILTI. So you remember a couple slides ago, we had that picture of the machinery on one side, and then I had the list of the 197 amortizable intangible assets. And so again, similar concept where Congress says, okay, 10% rate of return on your fixed assets, and then everything else is intangible income. So the first step in figuring out what your foreign derived intangible income would be to say, well, what is my deemed intangible income? And that's going to be, you know, your total income less 10% of your qualified business asset investment. So now you have the piece that's considered intangible income. And the next question will be, well, what portion of my deemed intangible income is foreign derived? And for that, you'll have to look at your foreign derived income over your, you know, your total income, apply that percentage to your deemed intangible income, and that's how you'll come up with the specific amount of income that would be subject to this reduced rate of tax in the U.S. And again, this benefit is only available for C Corp shareholders that own the IP in the U.S. and that have foreign derived income, say for instance, you know, licensing revenue coming into the U.S. from a foreign source. Note that this only applies to income that's earned directly by the U.S. company. So we have a concept of a U.S. company that might have a foreign entity that is a hybrid entity for U.S. tax purposes, or a foreign disregarded entity. So if we have U.S. parent with Israeli sub, but we made a check the box selection on the Israeli sub to treat it as a disregarded entity, any income that comes through this disregarded entity would not qualify for this FDII benefit. So it has to be income that's earned directly by the U.S. company.
Okay, so what I would like to point out with that is that if it's okay, Tanina, just right before we get to that polling question, is that if a U.S. company would like to consider putting their IP in the U.S., so they would be able to take advantage of this 13% tax rate. Now, what we see as the opportunity here is that often there's a business need that drives creating a U.S. company. That sometimes is coming from the investors of the tech company, in which they have a preference to invest in a U.S. company. And it also sometimes comes from the customer themselves, both in the U.S. and sometimes even for political reasons from customers from outside the U.S. that prefer to work with a U.S. company. So until now, operating in the U.S. was at a very high cost of 35%, and now we're potentially looking at a low rate of 13.125% when the IP is being held in the U.S. So we see this as definitely an area for planning and tax considerations going forward. And with that, Tanina, please go ahead and launch the poll question.
Sure. We are launching our third polling question. Now we have two more questions that came through the chat box. Did you want to take the time to respond to them now, or do you want to wait until after the poll?
Let's do the poll and then we can respond to the questions.
Okay, great. Leave the poll open for another 30 seconds. Going to close the poll and share the results. We had 29% no, 17% yes, and 54% does not apply.
Okay, so one of the questions related to a U.S. individual that formed a 100% wholly owned Israeli subsidiary as a service provider, and whether 100% of that income will now be taxed in the U.S. without a foreign tax credit offset. And unfortunately, the answer is yes. So the provisions in this new law are very favorable to C Corp shareholders, especially the international tax provisions are very favorable to C Corp structures. Anyone that's in a flow-through structure that owns a CFC, or if it's a U.S. individual that owns a CFC directly, that is no longer a favorable structure to be in. So there are pretty much two options. You can either check the box on your Israeli company and treat that as a flow-through, and so then you would get foreign tax credits. Or the other alternative is to see if it makes sense to insert a U.S. C Corp into that structure. Again, I don't know the facts and circumstances. I don't know where the business activity are, but many of our clients that are in flow-through structures currently are going through this analysis and determining, does it make sense to stay in a flow-through structure? Can we switch to a C Corp in the U.S.? Or does it make sense to check the box on some of our foreign subsidiaries? Obviously, checking the box on an existing CFC could result in a deemed liquidation, so it could be a taxable event. So there's a lot of things to think about, but the structure that was described in that question is definitely not a good structure under the new rule. There was another question that came through on...
Chaya?
Yes.
Actually, I think in the interest of time, how about if we address those questions either at the end or we respond to them by email?
Sure.
Okay, thank you. So Tanina, can you take us to the next slide, please?
So there are a lot of miscellaneous provisions in the new law that we've kind of tried to just focus on the ones that we think will have the biggest impact on the Israeli tech community. And so this is an interesting one that wanted to put out there so that it's on everyone's radar. The attribution rule for determining CFC status has changed, so it now includes attribution of stock owned by a foreign person. So if you look at this picture real quickly, in the past, the attribution rule said there's in the U.S. there's different forms of ownership. You can own something directly, or you can be deemed to own it based on a relationship that you have with someone that owns it. So one of the types of relationships is if you are a company and there is one of your shareholders owns more than 50% of, let's say for instance, U.S. Co. is owned more than 50% by foreign parent co., then whatever foreign parent co. owns, U.S. Co. is deemed to own. So that's the red line. You see that U.S. Co. now has constructive ownership of UK Co. under these new rules. In the past, if it was a foreign entity that you had the relationship with, you could not be attributed ownership to any other entities based on that. But now, the rule regarding attribution not working through foreign entities has been removed, and so now you could be attributed ownership. So currently, this U.S. company is attributed ownership of the UK company. Now, for purposes, Tanina, if you could go to the next slide, for purposes of CFC rules, subpart F, guilty, and even 5471 filing requirements, there is a backstop that prevents this from being an insane application. And across the board, so many companies where the U.S. company might be one in an entire global enterprise, and that is the U.S. company has to own a piece of the foreign entity that it's being attributed ownership of in order for the rules to kick in. So, excuse me, looking at this picture, pre-2018, this U.S. company that owns actual ownership of 10% of the UK company UK Co would not be a CFC, and there could not be GILTI, there could not be Subpart F, and you would not need a 5471. Under the new rules, because US Co owns 10% directly, and it's also has attributed 90% from the foreign parent, UK Co under the new rules is a CFC, there'll be Subpart F and GILTI exposure. So, you know, this is a very specific fact pattern. If you don't have this fact pattern, it doesn't, you know, you don't have to worry about it. But this is one of those things that you could be blindsided from because it's not necessarily intuitive. So, you know, the key takeaway on this one is if it's a U.S. company that owns 10% of a foreign, you know, any, not just 10%, any interest in any direct interest in a foreign related party, there should be this light bulb that goes off in your head or an alarm bell that goes off in your head that says, wait a second, our U.S. company might now, our foreign entity might now be considered a CFC. And Miriam, I think you mentioned that you see quite often where, you know, you might have like 1% ownership by the U.S. company. So that's the type of structure that we're looking to
definitely
identify
avoid
and see. Yeah. Identify and see what that means for us, and if there's anything we can do to change that around.
Okay, thank you for that. That was very helpful. Okay, so moving on to some other provisions which have come out with the tax reform. There's another new tax known as the BEAT, the Base Erosion and Anti-Abuse Tax. But this tax is only relevant for U.S. corporations that are dealing with an average annual gross receipts of greater than 500 million. And so Chaya and I assure you that when you get to that stage, you will personally receive a visit from us to discuss that tax. And so we're going to pass on that right now and move on to the next slide. Okay, so other aspects of the tax reform which are very relevant to tech companies. Firstly, any losses that are going to be generated as of January 1st, 2018. What's important to note that in years going forward, those losses will only be allowed to offset up to 80% of taxable income. So in a typical structure that we have in which a U.S. company is being formed in 2018, and years 1 and years 2 we're generating losses, but in year 3 in 2020 the company actually hits a profitable stage. Now in that first year of profit, that company will already be forced to pay tax because the NOLs that it generated in the first 2 years will only be allowed to offset 80% of that taxable income generated in year 3, and that 20% will still be taxable. Another provision to take note of which came out is that any R&D expenses which are being generated, and this is of course very relevant for technology companies, that in the year 2022, this is when this provision kicks in, those expenses will no longer be a 100% deduction in the year in which those are incurred, but rather if that expense is paid to R&D entities, employees in the US, it will now have to be recognized over a 5-year period. But even more so, if that R&D expense is being paid to an offshore entity, such as let's say an Israeli subsidiary, that R&D expense will now have to be spread over a 15-year period. So that is something that really will have an impact on technology companies. The breather is that we get some time to figure this out and don't have to deal with it immediately. We have until 2022 on that. Another provision to take note of is the interest expense limitation. And so if we have U.S. companies that are paying interest expenses, until now, generally those were limited if they were being paid to related parties. But now any interest expenses have a limitation in that they can only be used to offset, it depends on what the company's adjusted taxable income is. And in that case, it will be limited to 30% of adjusted taxable income. But again, to take note of that this has a $25 million gross receipts application, meaning if the company hasn't yet reached a level of 25 million in gross receipts, then this interest expense limitation does not apply. Next slide, please. So what we want to wrap up with as we get to the top of the hour is to introduce the new stock option benefits that did come out with the tax reform. And I see this also as an opportunity for technology companies that, of course, use stock options to attract talent and to retain that talent within the companies. Now, some of you may be familiar with what Israel offers for technology companies and for stock options, what's known as the 102 plan. And what's the nice thing about the 102 plan is that the employees or those that are holding those stock options get to defer the tax payment. Generally, when there's a transaction do they have to recognize that income and pay the tax. But in the US, it did not work that way, certainly not until the reform came out. In order to be able to benefit from the lower capital gain rates and recognize those lower rates versus ordinary income, the employee or the stock option holder would have to generally start that clock ticking by first performing an exercise. And only once that exercise happened were they then able to recognize the lower tax rates on any difference or any increase in value post the exercise until the time of sale. Now, of course, at the time of exercise, there not only is a payment that's due to the company, but in most cases, there was also a tax event and tax payment due. What happens now, and what the incentive is that came out with the tax reform, is that there is an option to make an election and to get that clock to start ticking without actually incurring the tax event right now. You would actually only incur the tax when any of the following events occur. The first one being a transaction in which there actually is an exit, which that works well because that's when the employee actually is receiving the funds on those stock options, or upon termination of the employee, or by no later than 5 years from the time that the election was made. So we definitely see this as inching closer to what employees may be familiar with from the 102 plan, and whereas until now U.S. employees were at a disadvantage in relation to their Israeli counterparts, this at least gives them a leveled playing field or somewhat closer to what the Israeli employees are getting. What's important to note, though, is that this is not relevant for any C-level employees like the CEO or the CFO. It's also not relevant if that particular employee is a greater than 1% shareholder of the company. And lastly, you have to be careful that this cannot be relevant to employees that are one of the 4 highest compensated employees in the company. Nevertheless, we still see this as something that can bring potential benefits to U.S. employees. Next slide, please.
Okay, we are launching our 4th and last polling question for the day. All right, launching this. We'll keep this open for 35 more seconds.
Okay, so as we wrap up, I just want to mention thank you so much, Chaya, for all your explanations. That was very helpful in clarifying some of the very complex issues. I do want to point out that Chaya will be in Israel in early February to discuss the tax reform and other international tax issues with our mutual clients. And we invite you to reach out to either one of us if you'd like to coordinate a meeting. So thank you, Chaya, and thank you, Tanina.
Thank you, and I'll quickly share these results for everyone. And I will advance to the last slide with the presenter contact information. And if there's no further comments, I just want to thank everyone for joining today's webinar and to please take a moment to complete our online survey. And if you submitted a question to the chat box and our presenters haven't been able to respond due to time constraints, they will be following up after the webinar. Okay, Haya and Miriam, are we good to end the broadcast?
Yes, thank you so much. We'll follow up with those open questions by email.
Great, thank you.
Thank you.